Recording in progress. Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg and Jayaram Krishnamurthy. Folks, it's been a busy last week for macro guys, chewing up all the updates, and so shall this one be, with four global central banks meeting lined up. And talking about central bank meetings, Indian RBI and its monetary policy committee kept the policy rates unchanged, even the stance unchanged, with the expectations for GDP slightly moving higher. It was also quite interestingly communicated that USD-INR may continue to remain stable for the time being unless we see any major move in the dollar index. Friday, we also had the NFP numbers, which led to a knee-jerk reaction before the week's close. So, JK, I'd like to know more from you, like what sort of an expectations are we having for this week with the inflation updates and the central bank meetings looming?
Good morning, Shikhar. Yes, before we get into what's ahead this week, let's dwell on what happened on Friday. The jobs report was an important event for the market as it brought down the speculators closer to earth, mellowing down extreme expectations on monetary policy change. The data itself was not so much of a beat, both on NFP, on the unemployment rate as well as the wage inflation, when you consider that in November, a large part of the striking auto workforce returned to work. The data being better on the face of it, it did prompt a scaling back of not only expectation, but also the extreme positioning, particularly in the bonds. And immediately, expectations of rate cuts by Fed has been sized down. Fed Watch tool shows, which showed 65% probability of a cut in March, is now at 45%. And from near 85% probability in May to 76%. Quantum of rate cut priced in now is at 1% versus 1.25%. Now, this was a much required correction, despite the fact that this beat in data came after a consecutive months of weaker number and other indicators like JOLTS, ADP, Challenger. They've all been weak, which cannot be ignored as well. Therefore, Fed would likely see more employment data to confirm whether it is really, going back to the stronger phase or whether the weakness will continue. So it's not conclusive as far as the central bank is concerned. For the market, it has given a scope for correcting their extreme positioning and then now wait for what's ahead in this week, of course. The other important number which prompted some more short covering in the dollar and scaling back of bond position was the Michigan consumer sentiment preliminary reading that came at 69.4 versus 61.3 in November, erasing all the losses of the previous 4 months. While the current conditions improved from 68.3 to 74, and expectations also went up. Now the sentiment is about 39% above all-time low measured in June 22, but still well below the pre-pandemic levels. Now, the important point is that these higher numbers were seemingly the result of much lower expectation on inflation, which dropped from 4.5% to 3.1% on 1 year, 3.2% to 2.8% for the 5 years. So when consumers have a perception that inflation is going to fall, obviously their sentiment also improves and expectations also improve. Now there was one more important data over the weekend. That's deflation in China. Deepening in deflation has tightened its grip on the entire Chinese economy, underscoring the urgency behind Chinese Communist Party and the president, for increasing government's fiscal stimulus. Consumer price index was minus 0.5% year on year, more than 0.1% drop that was expected by the economists, and the fastest slide since November 2020. The PPI also was minus 3% year on year compared to October's 2.6% minus and expectations of a 2.8% decline. So November marks the 14th straight month of PPI decline and the quickest since August. These data all meant that CNX will weaken. It has weakened, and the market expectations of further stimulus is now rising. Now, onto the markets, of course, stocks closed higher after some volatility, particularly on the Nasdaq, notched up the highest closing ever since early 2022. Bond yields were higher across tenors, particularly in the 10-year, it moved up by nearly 15 basis points, and the 2-year as well moved up. On the currencies, there was a mixed reaction. Euro went down and came back to the pre-data level, and which means that there seems to be some sort of underlying demand for euro. And the biggest recovery in USD happened against the yen, which had fallen, if you remember, at 141.65 in early Tokyo hours on Thursday. And this was reversed to a great extent, and we are now trading above 145. It's a big recovery. But then Japanese authorities are also looking to soft land the yen. I mean, yen is weak, no doubt, but they don't want the yen also to move drastically on one side to create market turbulence, and that is the reason why they make statements favoring yen strength when it is weak, and then when it comes down, there is some sort of an action, which was probably seen on Friday as well. Now, the yield advantage on euro against the euro by the dollar has increased now, and the German US 2-year spreads recently broke below the channel support, and now September wides are actually in play, and expectations that ECB may be cutting before Fed is also leading to these widening of differentials. But despite this, euro has not really crashed. So which means that there are other factors which are supporting a dollar, not so much of a dollar strength, which we should bear in mind. One more important news that came was US is starting to buy oil for rebuilding their strategic reserves. 3 million barrels of oil will be bought for March delivery. That's a news, so that may be behind some support for oil. Now on to the week's events. Yes, consumer price inflation, which will be out tomorrow from the US, of course, from India as well. The CPI month on month is expected to slightly increase by 0.1%. Year on year is going to be showing a drop by 0.1%. It is still very, headlines are looking like this, but then we really need to go into the details of how the services inflation is passing, particularly on the rentals as well as the used cars. These are the important events, details of the report that we'll have to parse. But overall, I think inflation is kind of moderating trend only, but whether it is going to stall at previous month's low or it's going to drop further is what we will be looking, and Fed will also be looking as they meet on Wednesday. So Powell's statements, dot plot, Fed statement, all of these will be very closely looked at on Thursday morning, or rather Wednesday night, to see whether they are changing their their own forecast. GDP and inflation. Besides GDP and inflation, of course, the biggest focus will be on the rate cuts. Last dot plot did not indicate any rate cut for 2024, but looking at the way economy has been responding with a lag to the high rates, whether they would indicate some rate cuts for the year. Some say the dot plot could indicate there are some economists who have been forecasting Fed's forecast. So they are saying the rate could be cut by 0.5% as per dot plot. So this is a forecast on the dot plot itself. So we'll have to wait and see how this actually comes about. Rupee, slight reaction to NFP number on Friday. It seems to be now settling into above 40. Maybe the range is being shifted by RBI between 35 and 45. That is something, but really don't expect any bigger movement in the rupee, despite the fact that this month we have had very good inflows, almost equaling the entire flow of the entire month of November. So that's a good news from the flow point of view, but to expect more movement in the rupee, it seems to be really extremely optimistic. Monetary policy did not hold any impact on INR, except that we are awaiting some new guidelines on hedging for corporates, which will be coming out soon from RBI. Forecast of GDP higher than earlier expected at 7% is a good news for investors, and ensures that the long-term flows into India will be on track. Thank you.
Okay, JK, that was really good. And yes, folks, there's a lot of details that need to be passed in the coming days with respect to inflation or the FOMC updates, and we will continuously be bringing you all these updates on regular basis. Meanwhile, as JK mentioned, we await new guidelines on the hedging from the Indian Central Bank for the corporates, and apart from that, not much expectations of movement for the USD INR as the currency pair. On the other hand, deflation in China has continued to deepen, further rising the expectations of stimulus by the Chinese authorities. Apart from that, the inflation expectations in the longer tenor has been improving for US, and also the kind of NFP numbers that we've seen, it kind of mellowed down the investor expectations or the extreme positions, especially in the bonds, while also bringing down the probability of rate cuts expected in the months of March and May. So all in all, this is what we can say for the time being, and there's a lot more things to come up. Whether Japanese authorities will be able to soft land yen, or we see another expectation rate of rate cut increasing. All this we can look to be answered in the coming few days. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.